What's up, everybody? This is Sunko, the Korean bro. Today is 2023, June 25th. Let's see, okay? Hmm. One low risk financial stock that's crushed market. These high yield dividend stocks could deliver monster returns. Hmm. Five hash paying S&P 500 yearly 2.9. Okay, let's see. First, one low risk financial stock that's crushed market. Visa stock has crushed market since going public. The company has a dominant position in the payments industry and will be incredibly hard to disrupt. Shares trade at a premium valuation but should still do well over the long term. Industry dominance and market outperformance. Is disruption coming? Placed in any investor's portfolio. Sometimes you can pay to own early stage stocks with extremely high growth potential. Being early into stocks like Tesla or Amazon can create life changing wealth for your portfolio, turning $1,000 into hundreds of thousands of dollars within a few decades. But, but buying these types of stock doesn't come without risk and shouldn't make up 100% of anyone's portfolio. That's where blue chip businesses with strong competitive advantages comes in. Since Visa is such a good business, it typically trades at a premium valuation. Today, its price earnings ratio sits at 30, which is above the market average but below where it typically traded for the past 5 years. Last quarter, Visa's net revenue grew 11% year over year and steadily compounded over the last 10 years. With the continued growth of digital payments around the globe, this 10% plus growth should continue for the next few years, if not longer. Hmm. Hmm. Bull market is coming. Three reasons to buy Roku. Okay, let's see Roku. Okay. Today, 2023. The streaming video market is poised for massive growth, projected to reach $1.9 trillion by revenues by 2030. Regardless of which content providers emerge victorious in the streaming wars, Roku stands to benefit as a central technology platform. The downturn in digital ad sales should be short-lived, presenting Roku with rejuvenated revenues and profits. Ever thought about tapping into a $1.9 trillion market? Here's a hint: the future is streaming. Raging inflation and fears of an upcoming recession sent the stock market into a bear market in 2022. The S&P 500 and Nasdaq Composite Market indices are still roughly 10% below the all-time highs of late 2021. However, no market meltdown lasts forever. The two leading index values are up 14% and 37% in 2023, respectively. So Wall Street has almost recovered from the market fears of yesteryear, and there should be more gains in the months and years ahead. Every bear market in history has been followed by another bull market. It looks like we're watching the next button hand up right now. Okay. Well, wherever we are in the ever spinning market cycle, master investor Warren Buffett recommends buying shares of top quality companies with a robust competitive advantage. It's even better if you can find that excellent stock at a reasonable price per share. That's what I see in a media streaming technology expert Roku right now. The company faces incredible long-term growth in the massive global market, but Roku stock trades on the cheap for all the wrong reasons. Here are three crystal clear reasons why Roku is my favorite buy right now. Okay, let's see. Hmm. The streaming video era has only just begun. Every media producer worth its salt is switching gears to the digital streaming field nowadays. The streaming, the streaming wars are pitting specialists like Netflix against flexible sector titans such as Walt Disney. Everyone wants to offer the best mixture of proven winners and viewer winning originals, and the long term winners have not been decided by a long shot. The market analyst at Fortune Business Insights pegged the video streaming market at $456 billion in worldwide revenue last year. By 2030, the revenue stream should nearly quadruple to $1.9 trillion. dollars. This overview includes every part of the streaming opportunity, from content producers and streaming services to technology platforms and supporting software sales. And whoever ends up winning the streaming content battle, Roku will benefit from soaring interest in the digital video idea as a whole. When Netflix and Disney spar over new viewers with fresh titles and new or improved services, Roku Smart TV platform stands ready to support both of them. Roku is in full control of its financial future. Netflix and Disney spar over Netflix and Disney spar over new viewers with fresh titles and new or improved services. Roku Smart TV platform stands ready to support both of them. Roku is in full control of its financial future. You may have noticed that Roku's top line growth has slowed in recent quarters, leading to bottom line losses and negative cash flows. You should know that the company is well equipped to handle a very long downturn. In the first quarter of 2023, Roku reported a year over year revenue increase of just 1%. The bulk of this company sales come from selling targeted advertising space across the media viewing platforms interface and the 100% ad supported Roku channel. Year over year revenue increase of just 1%. The bulk of this company sales come from a selling targeted advertising spaces across the media viewing platforms interface and 100% ad supported Roku channel. Due to economic pressure, most ad buyers have tightened their marketing belts dramatically in recent quarters. Marketing campaigns will surely be more effective when consumers are ready to buy stuff again. Hmm. Due to the limited ad sales, Roku saw a net loss of $1.194 million. Free cash flows clocked at a negative $208 million. However, Roku could have avoided this scary bottom line results by reducing its spending on research and development or pumping the brakes on its own marketing efforts. That's what you would see in a real crisis. But Roku boosted its R&D spending by 34% while lifting its sales and marketing costs 60% higher, both in comparison to the year ago quarter. This is spending style of a thriving business whose management would rather lay the groundwork for continued growth instead of catering to short-term pressures. And what if these negative numbers keeps coming? Well, Roku may have burned $0.2 billion in cash reserves in the first quarter, but has another $1.6 billion of cash equivalents on hand and zero long-term debt. In fact, the company paid off last strips of existing debt papers with an $80,000 check in the first quarter. So Roku has several financial levers to pull and robust pool of cash reserves to lean on. So they are in control of its full financial future. The advertising downturn will be short lived, and I don't see the digital ad sales downturn lasting much longer. The inflation crisis is long past its peak. Hmm. And even the anti inflation interest rate increases should calm back down in the second half of the year. When they do, we should see a muscular inflow of revenues in the ad space. It's 2 years of fairly quite productive development and market research certainly connects to refreshed marketing budgets. I don't expect Roku to change its business plan very much when that happens. Just let the rejuvenated revenue streams refill the cash coffers. Operating expenses like marketing and R&D will continue to soar, as they already did during the inflation-based market crisis, with a renewed top-line growth trend, return to strongly positive cash flows. Both growth and value investors should find something to celebrate in Roku's long-term prospects. The stock price, which currently sits 87% below the all-time highs of 2021, seems likely to skyrocket as a result. Please double check my assumption production before investing real money in Roku stock. That's only sound investing, exactly what Warren Buffett would do. Whatever you may find, one fact remains. This is my favorite stock recommendation, the current my by a long shot. Okay. Coca Cola. Johnson and Johnson. Hmm. 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 Advanced micro devices, AMD. Okay. Okay, is one of the industry's most popular chip manufacturers, and its hardware powers a number of high consumer products like Sony's PlayStation 5 and Microsoft Xbox. Hardware powers, but it's also emerging as a key competitor to Nvidia in the AI chips built for data centers. Earlier this month, the company revealed detailed specifications for its new MI300 chip. The company revealed MI300 is uh, MI300 chip, which is already slated to power the world's most powerful supercomputer coming online later this year, called EI Captain. Plus, rumors are already flying that the world's largest cloud service provider could be interested in the MI300 after spending years as one of NVIDIA's most loyal customers. Okay. Hmm. The chip comes in multiple configurations, including a first of its kind advanced processing unit, the combined central processing unit, and GPU hardware. It can also be purchased as a standalone GPU, which is what most customers will be looking for. However, it has been designed to require minimal adjustments to existing data center infrastructure to make the upgrade process almost seamless. The MI300 could be a game changer for AMD as it tries to chip away at NVIDIA's dominant market share in the space. AMD stock surged 75% so far this year, though it remains at 27% below its all-time high. Over the long term, I think it could soar more than fivefold to catapult the company into the $1 trillion club alongside Nvidia. And the next one that I'm going to talk about is CrowdStrike Holdings. Do I have CrowdStrike Holdings? Crowd. Okay, there you go. CrowdStrike Holdings. First unique growth stock that's bagging to be bought with the notch is still well off its record closing highs as cybersecurity company CrowdStrike Holdings. Though there are concerns the US recession could lead to earnings multiple contraction for high growth stocks like CrowdStrike, the company's key performance indicators show it's firing on all cylinders. That's bagging to be bought with Nosh is still well off its record closing highs. A cybersecurity company. But there are concerns the US recession could lead to earnings multiple contraction for high growth stocks like CrowdStrike. The company's key performance indicators show it's firing on all cylinders. The first thing to understand about cybersecurity solutions is that they've evolved into a basic necessity service over the past decades. But cybersecurity solutions, they've evolved into basic necessity service over the past decades. Hackers and rogues angling to steal sensitive information have grown more sophisticated and don't take things off just because the US economy or Wall Street hits a rough patch. With businesses shifting their data online and into the cloud at an accelerated pace, it's a third party providers like CrowdStrike. They're picking up the slack in any environment. What makes CrowdStrike such a phenomenal business? Its artificial intelligence driven platform known as Falcon. Hmm. What makes CrowdStrike such a phenomenal platform known as Falcon? Uh, every week Falcon is overseeing trillions of events. With the aid of machine learning, Falcon is growing more efficient over the time at recognizing and responding to end user threats. The interesting thing about CrowdStrike is that it offers one of the pricier solutions available. But in spite of Falcon's higher coverage, clients are sticking with the company. Over the past 6 fiscal years, the company's gross retention has jumped more than 400 basis points to 98%. Gross retention has jumped more than 400 basis points to 98%. Gross retention. Original CrowdStrike more than 23,000 existing subscribers keep adding into their initial purchases, whereas a single digit percentage of its customers had purchased four or more cloud module subscriptions 6 years ago. 62% of its clients have purchased at least five cloud module subscriptions as of its most recent quarter. These add-on sales are crucial for cash flow generation and operating margin expansion. Okay, let's sum it up. What makes CrowdStrike such a phenomenal business is its artificial intelligence-driven platform known as Falcon. Falcon is overseeing trillions of events. With the aid of machine learning, Falcon is growing more efficient over time at recognizing and responding to end-user threats. Over the past six fiscal years, the composite gross retention has jumped more than 400 basis points to 98%. CrowdStrike's more than 23,000 existing subscribers keep adding on to their initial purchases. Yeah. Expect a roaring S&P 500 bull market. Here are the top 10 stocks you want to own. Let's see what they are. Nvidia. Hmm. Most actively managed funds underperformed the S&P 500. Investing in an index fund provides security without stress. It also provides gains that are hard to beat. You don't need to invest in risk stocks to make a lot of money. It's hard to beat the market. There are people who manage the fit, but they're a tiny minority. Interestingly, and maybe not surprisingly, it's easier to beat the market when the market tanks. So in 2021, when the market gained 29%, 85% of money managers underperformed the index. In 2022, when the S&P 500 lost 18%, only 51% of money managers underperformed. And if that seems like success, remember that it's still more than half. If that still sounds impressive, consider that the market gains annually far more frequently than losses. That means that overall, the market is much more likely to outperform any actively managed funds. Hmm. If you can't beat them, join them. Even Warren Buffett, one of the tiny few who have done it, advises most people to invest in an index fund that mirrors the S&P 500. Over time, it has been one of the most powerful vehicles for creating wealth. It's also less stressful than picking out which you hope will be winners. Buffett has said that he's advised his wife to invest all her money in the S&P 500 after his death. It's simple to calculate how much money you'd have today if you did just that 20 years ago with $10,000. That total will be more than $65,000, which implies a return of 555%. That includes all the dividends. By the way, you'd make this much without worrying about which stocks are going which way or whether to pull from one and add to another. Of course, you can invest this way in addition to owning a portfolio of single stocks, just like Buffett's Berkshire Hathaway. A diversified group of about 25 stocks chosen with care, plus or including an investment in an index fund, provides excellent chances of creating a healthy, market-beating stock portfolio. But if all you did was invest in the market through an index fund, you'd be just fine. Don't discount monthly contributions. Here's where it gets even better. If you had made monthly contributions over time, you'd have made much more money. Over the past 20 years, the index has gained a total average annual returns of around 10%. If you initially invested $10,000 and added $100 per month, you'd have $136,000 today. For those who did the math, yes, you added $24,000 over these 20 years, but since that haven't been invested for the full 20 years, they haven't borne the full fruit of compound interest yet. Why it makes sense to invest in the market? One of Warren Buffett's recurring themes when he talks to shareholders is his confidence in America. And investing in the stock market demonstrates confidence in the potential of the US and its business. There will always be events that affect the market in the short term, whether for good or for bad. They're almost never predictable. Consider the COVID 19 pandemic, practically the epitome of a black swan event, or an event that you cannot predict. Investing in the market gives you the power of the long term story that America brings to the table and to your wallet. Living through this period of severe inflation might hammer this home. There have been worse times, even periods of hyperinflation. Those are rare and they may not come to pass again in your lifetime, but having funds in an S&P 500 index fund provides security despite any challenges in the environment. It still offers incredible long-term gains. So this author specifically mentions the reason that you have to buy S&P 500 over the long term. I mean, like every month you pay certain amount of money, and then the next day, or I mean, not like the next month, you pay exact the same amount, and then in the next month you pay the exact same amount, and you do it over and over and over for 20 years, and then at the end you will see that it's accumulated, and what you see will be like 555% return or something like that. If you'd invested $150 the S&P 500 since 1993, here's how much you'd have today. Mm, Okay. Patient investors can build a multi-million dollar portfolio by consistently buying an S&P 500 index fund. The S&P 500 tracks the performance of 500 large cap American businesses. Its constituents span all 11 market sectors, and the index covers about 80% of the total market capitalization of the US stock market. That scope and diversity make the S&P 500 an excellent benchmark for the broader US economy, which itself is the largest and the most innovative economy on the planet. Indeed, 15 of the 20 largest companies in the world were created in the US, and JP Morgan Chase CEO Jamie Dimon has called America the most prosperous economy the world has ever seen. The S&P 500 has been a consistent moneymaker since its inception in 1957. The index has never failed to produce a profit over any rolling 20-year period and returned 1,680% over the last 3 decades, which is equivalent to 10.06% per year. That means $150 invested weekly since 1993 will be worth $1.33 million today. And that sum would grow into 3.5 million by 2033, assuming that the pace of investment and rate of return remain constant. The Vanguard S&P 500 ETF is one of several good S&P 500 index funds. It is nearly identical to BlackRock's iShares Core S&P 500 ETF, but slightly cheaper than State Street's SPD or S&P 500 ETF Trust. It makes sense to regularly invest small sums of money in an S&P 500 index fund. That strategy is called the dollar cost averaging. It keeps investors from falling prey to the perils of market timing. Also, the strategy is called dollar cost averaging. It keeps investors from falling prey to the perils of market timing. Also, makes sense to hold the fund for at least 5 years. Though longer holding periods increase the odds of profitability and allows more time for compounding to work its magic. As mentioned above, the S&P 500 returned a total of 10.06% per year over the last 3 decades. The chart below uses this rate of return to illustrate how different weekly contribution amounts would grow over different time periods. $7 million. $7 million. Okay. The one that I'm going to look at today is hmm, let's see. Hmm, let's go see the C3.ai. Is this the real reason behind C3.ai Modi's guide and AI help these three stocks, or is there more to come? Shares of C3.ai have been rocketing higher this year, even though its financial performance has been disappointing. It's still a bit early, but it looks like Shopify's AI fueled tools can attract more subscribers. Okay, let's go first. C3.ai 2023, June 26. With AI as its ticker symbol, it's easy to see how C3.ai got swept up in the AI stock race. Shares of the enterprise AI software provider have gained 66% over the past 3 months. Unfortunately, betting on a repeat performance from this stock probably isn't a great idea. According to management, interest in applying AI to business processes is more active than it's ever been. Unfortunately, enterprise customers are looking to C3.ai's competitors for the solution. Sales during the company's fiscal fourth quarter ended April 30 rose just $0.1 million year over year to 72.4 million. Betting on a repeat performance from this stock probably isn't a great idea. According to management, interest in applying AI to business processes is more active than it's ever been since. Unfortunately, enterprise customers are looking to C3.ai as competitors for solution. A stagnating top line is a particularly bright red flag for this growth stock because the business is bleeding money and the losses are widening. A stagnating top line is a particularly bright red flag for this growth stock because the business is bleeding money and the losses are widening. red sign. Betting on a repeat performance from this stock probably isn't a great idea. According to management, interest in applying AI to business processes is more active than it's ever seen. Unfortunately, enterprise customers are looking to Z3 AI's competitors for solution. Sales during the company's fiscal fourth quarter ended April 30 rose just 1 million year over year to $72.4 million. Okay. So red sign definitely for C3 AI. Okay. Now let's go over C integral as science holding. Okay. Integral as science holding. Integral as science. Okay. Integral as science holding. Why integral as science stock jumped 9%? Hmm. Anyway, this is it for today, and see you guys tomorrow. Okay, bye bye.